All right, welcome Plus 60 crew to the How to Not Outlive Your Money presented by Cody Allen and with Northwest Bank and Trust Company. Let's go ahead and get started with the program because we have a lot to cover today. Today's program is going to focus really on how to not outlive your money in these unique times. We have a lot of moving parts in the world right now. Let's make sure that we have up with a plan and a strategy that puts things into place to ensure that we have a good and solid understanding of where we head from here. A little background. My name again, Cody Allen. My name is Cody Allen. I'm with Northwest Bank's Investment Management Group. I've been with the department for 14 years, been doing investments for a little over 20 years. Our department today takes care of around $325 million in assets for local Quad Cityans that are planning for retirement, that are in a situation that they are likely at or near retirement already. So my assumption is that fits the mold for a lot of you. We have seen tremendous amount of volatility the last 6 months, unprecedented. The 6 weeks that we saw in February, March, and April were some of the biggest swings that we've seen the markets take in the history of the markets. So we have plenty to talk about and plenty of things to cover. So we'll dive right in and get started. Today's agenda, first of all, we're going to talk a little about the markets. Just spend a moment talking about where we're coming from the last 12 to 18 months. The markets have been on quite a ride, and it'd be good for us to spend a little time on that. And we can't talk about the markets today without talking about the elections. We'll spend some time talking about where the world stands today and what types of things are going on right now with the presidential elections that are coming up in November. Then we're going to dive into the top 4 questions I tell everybody they need to ask about their financial situation. And this is before we start talking about what stocks to buy, what bonds to buy, what mutual funds to buy. Before we get into that, we need to come up with a strategy of how do I ensure that my plans are going to be in order over the course of time? How do I ensure my savings are going to last over the course of time? And how does my financial advisor measure success and failures? How do I work together with my advisor to do that? And then the last item is my financial advisor a fiduciary? A lot of big important parts that we want to make sure are being taken care of in the right manner. So let's dive in. First of all, market update. Let's spend just a moment talking about 2019. 2019, we saw a number of items take place. When we entered the year, we were quite into a situation that we felt the markets were going to be pretty lethargic all year long. However, all the political headwinds that we thought were going to happen really didn't happen, and the markets had a fantastic year. The S&P 500, which you can see on the bottom of the screen, produced a rate of return of over 31%. The international markets did well also. They did a return of right around 23%. Even the bond indexes, bonds had a nice year, around 8.5%. So a good year overall. Here's what happened. We saw the Federal Reserve cut rates 3 times in 2019. They came into the year saying that they were going to actually increase rates 3 times. The U.S. and China, quite a bipolar relationship over the course of the year. But in December of last year and first few weeks of January of this year, we saw them get to a phase 1 agreement for the trade deal, which was great stuff for the markets and for the economy. The next item was Brexit. As we know, England is leaving the Eurozone. From that standpoint, how orderly is that going to be? Is that going to be a smooth transition? And some of the elections that took place over in England made that continue to move at the right pace. So we felt good about that. So all in all, the U.S. market, international markets, and the bond market had a nice year in 2019. Despite the fact that company earnings, corporate earnings came out, and they were pretty unimpressive. We entered 2020 hoping for a year in which the corporate earnings numbers would turn around and look better. And from what we saw the first few weeks of the year, they did. And then came along this little situation of the COVID-19 situation and what the world needed to do to adjust to this most unusual time frame. If I had a quarter for every time I've had to say unprecedented times, I'd be much wealthier spot today. So let's talk a little bit about where we're at. First of all, what happened when the COVID situation started, when we started to see the panic and the unrest and the uncertainty of where we're heading, we saw the Federal Reserve, not the federal government just yet. I'm going to talk about the Federal Reserve. The Federal Reserve came in a big, big way. They slashed the overnight rates to 0, which is allowing some businesses to free up the ability to borrow and to be able to get money at very cheap rates, which was great. They also enacted quantitative easing. They were buying a number of dollars towards corporate bonds, governmental bonds, and that process helped build a floor underneath the markets. And it was at a time that we needed it most, right when the markets were seeing the severe pullback because of that uncertainty. The next item that we saw is we saw the U.S. government implement the CARES Act. The CARES Act came in with a $2 trillion bill, and that's where we saw a variety of things. We saw the stimulus checks go out to individuals. We saw the PPP loan process get enacted for businesses. We're seeing the Main Street lending program for nonprofits. A lot of good stuff coming about from what the U.S. government did as well. So in a little bit of review, the Federal Reserve acted quickly, the U.S. government acted quickly, and the actions taken by these two really propped the floor underneath the markets. Now the question is, can the markets survive on their own? And that's the million-dollar question that we walk into for the remainder of the year. There's, of course, the uncertainty as to where we're going to head with continued outbreaks. Are we going to see a vaccine? A lot of uncertainty as to where that's going to head. Next, what we want to see is that we want to see company earnings recover after this severe downturn. So far, as we record this today on July 30th, we're in a situation right now where we're seeing some decent numbers coming out on company earnings, that they are beating estimates, generally speaking, for second quarter earnings. Now, part of that might be tied to the fact that the expectations were so low. The expectations in this year, or the second half of this year, has gone so low that they had nowhere else to go but up. So we will see where that heads. Company earnings are still a very big to be determined type of situation. And then we get into everybody's favorite topic, it seems like these days, when it comes to the economy and the markets, is what's going to happen with the elections. So I'm going to spend a little time talking about that, just a little perspective, and then we're going to dive into those questions that I mentioned on the agenda. So items on performance of the markets during election years. This is a nice little slide. It goes back to 1950, and it says, okay, there has been 16 election years since 1950. How many years have been up? How many years have been down? And what's been the average rate of return? So this is the look at the S&P 500, which is a nice barometer for how the U.S. stock market is measured. The U.S. stock market is measured by the S&P 500, and the S&P 500 includes the top 500 companies in the United States. So a nice measure, a cross-section of the big companies in the U.S. So there's been 16 election years, 13 have been up, 3 have been down, with an average rate of return of around 6.5%. You can move to the right, you can see election year plus 1. The number of election years, number of election years plus 1 has been 9 up, 7 down, with a rate of return of 6.5%. You can see election year plus 2 pretty much follows the same suit with a rate of return of 7%. And election year plus 3 has really been the best place to be from the election cycle process, with a rate of return of around 16.5%. So that's the year we just came out of. That's 2019. A little perspective. This is, again, just more of a gee whiz type of comment about what are normally the best years in a presidential cycle. Where do we stand? This doesn't have anything to do with Republicans or Democrats or what have you, just a general look since 1950. So then we get into scenario of another topic that we oftentimes hear from folks is, maybe I should sit on the sidelines. Maybe I should wait till this election gets figured out and the social unrest that's going on right now gets a little bit more direction to it, and we figure out where the world's going to head from there. So we get the question of, should we sit on the sidelines and wait? My comment to that is that this is a fun little slide, and there's a lot of variables to it, but I'll mention this slide, the chart on the left first. The chart on the left simply says, if you took $10,000 and invested into the Dow Jones back in 1896, and you went into a situation that you didn't touch it, you left it grow for that entire time frame, your $10,000 is now grown to $7 million. Now, if we said, you know what, I want to only invest when my party's in favor. So whether Republican or Democrat, if you said, again, invest $10,000 back in 1896, and you invest that $10,000 only when your party's in favor, you're going to end up with less than $1 million in growth. And you can see that here on that chart on the left. Just again, a gee whiz that talks about how it is difficult to guess what's going to happen when we get into that scenario. Now, the chart on the right is one worth talking about a little bit. And it's the idea that the economy and the U.S. stock market likes gridlock in D.C. And here's what I mean by that. If we look at the right-hand side, it talks about the annual rate of return of the U.S. stock market is at 7.8% when the White House and Congress are divided. So when we get into a situation of those two being divided, the stock market likes that. It likes that slow and steady process, that there's not too many curveballs being thrown at it. And then you get an average rate of return of around 7.8% when those two are divided. And again, this goes back to those historic numbers, actually going back to 1901 on this particular chart. If there's a unified house, regardless of it's owned both by Republicans or both by Democrats, the rate of return goes down pretty dramatically. Now we see a situation of 4.7% is the annualized rate of return. Again, just a little perspective on some of the things that we see out there, regardless of the party affiliation. This next slide is kind of one that I like, and it talks about the presidential approval ratings. And oftentimes we feel like if presidential approval ratings, maybe things aren't going well. What's happening? What does the market see? So this is a fun little slide. Again, more of a gee whiz, but just a little perspective. The goal of my election slides that I'm talking about here is to provide you a little perspective that at the end of the day, whether it be Democrats, Republicans, or these unique times that we're living in, the market is good and efficient and will figure out how to operate around DC. So this slide particularly says the presidential approval ratings and the markets don't always move in the same direction. So bear with me. Right now, we're in a situation that the presidential approval ratings right now, depending on the poll, average between 35 to 50%. And that's the red number that's highlighted there on the right-hand side. When we have those approval ratings of 35 to 50%, the annual growth rate of the equity market is right around 15%, actually a little bit better than that. And during that time, during the last handful of years, that has been the case for about 36 to 37% of the time. So again, just to recap, presidential approval ratings don't always mean bad things for the markets. So with the president's approval ratings hovering between 35 to 50%, again, depending on what poll you want to look at, the rate of return on average over the number of years has been around 15%, and that's happened about 36% of the time. So again, more gee whiz type of comments, nothing that you can really put into play other than my point is stay the course, stay consistent. Don't let DC concerns disrupt your portfolio. We can go back to a handful of examples in recent times as to what's happened with an election here or there, but ultimately the US stock market is good and efficient and will find its way. So that's a little update on 2019, update on 2020, the things that we're watching with the elections. Let's dive into the things that we need to do to make sure our portfolio is doing what it needs to stand the test of time. The item number one is how do I ensure my financial plans are in order? What do I need to do to make sure that things are being taken care of in the appropriate way? And what I tell folks is that we need to make sure we understand why we're investing. When I have a new client walk in the door and we want to talk about investing in a portfolio, we really need to understand where they're at in life. Are they in a situation where they need to make sure that they have an emergency fund set aside, they're ready for college education, and retirement planning is maybe not the first step? Or do I have a client, which most of my clients are, at or near retirement, and retirement is item number one. The kids have flown the nest, we might even have some grandkids in the picture. What are we doing to ensure that their financial aspects are being taken care of in retirement? Okay? The next item then is that we do have clients that are in a situation that they have already progressed through a number of their retirement years, and now they're starting to think about what happens when the assets go to the kids and the grandkids. How do I make sure it's done in the most tax efficient and appropriate manner to maximize what they're going to receive? These are normally the cases in which we look at investing for folks. This is normally where we start. Okay, so why do we invest? What are we here for today, and what are we setting up for them in the future? So the three basics, and some of this might be, well, of course I know that, Cody, why are you going over such basic details? But I want to start at the root. When we get into a situation, the first thing we always tell people is we need to build a team. We need to ensure we have a team in place that makes sure that we're doing things most tax efficient, the most appropriate for our risk tolerance, and being done in a manner that's going to pass to the next generation as smoothly and cleanly as possible. The second thing that we need to do is make sure we make a commitment. We need to make sure we make a commitment and we stay disciplined. What unique times to try to stay disciplined, right? We saw the US stock market, the Dow and the S&P, fell from their highs in the course of 6 weeks or so in this market at about 35 to 37%. It's hard to stay disciplined in that type of environment, but it's the most important thing to do when we get into these scenarios. Okay? And we'll come back to that here a little bit in a moment. So building the team. What do we need to do to make sure we have a team that's appropriate in place for us? So when we get into a situation that we're building a team, the first thing we want to do is make sure we've got a financial advisor in place that's taking care of our dollars in the most appropriate manner for our risk tolerance, our time horizon, and our objective. Okay? So we want to make sure that financial advisor is taking care of us and knows our goals and expectations. The next thing we need to do is make sure we have an attorney that's drawn up a good estate plan for us, whether it be a will, whether it be a trust. we need to make sure that we have something in place that ensures if something happens to you, things are going to run smoothly for the next generation or for the charity or for the individual that's going to be receiving our assets in the future. The third thing that we need to do is make sure we have a CPA that's ensuring that all this is being done in a tax efficient manner. The most important thing that we can do is to make sure that these three arms are able to talk to each other and work smoothly and make sure that they know your goals. Okay? And 2020 has been quite a year to make sure that we have this team in place. I'm going to give you an example as to what things you should be talking to your advisor, your attorney, and your CPA in 2020. First of all, your financial advisor. It's a great time right now with the market having a really nice recovery since its lows back in March and April. Sit down with your financial advisor and say, am I invested the way that I should? Should I be more aggressive, less aggressive? Did I fool myself? Should I not have been as aggressive as I was? And now is the right time to make that move. You need to make sure that you've got a financial advisor you're talking to about those things if you have questions. The next thing we need to do is make sure we're talking to our attorney. We had some pretty significant tax changes that took place and estate planning changes that took place in December of 2019. So just 7-8 months ago, the Secure Act was passed. And one of the biggest items in the Secure Act that's affecting my retired clients is that we're in a scenario that now when they pass their IRA or their 401k or their 403b off to their children or their grandchildren, their niece and nephew, when they pass that off to that family member now has to have an accelerated rate in which they have to have that money out of that qualified plan. And that means tax impacts. So what we want to do is to make sure the attorney has our beneficiary designations in line with the estate plans we've drawn up. Again, something that's really taken place since December of 2019. The last thing we need to do is make sure that when we're talking about 2020, a great example of a conversation we should be having with our CPA, we have no RMDs that we have to take from our IRAs this year. And for those of you that are not 72, you don't have to take distributions out of your IRAs, but maybe should we? One of the things that we're spending a lot of time talking to clients about, should we be moving money from our traditional IRA to our Roth IRA? For our retired clients, it's been a big conversation for two reasons. One, if we have to take RMDs, we don't officially have to take them this year. So now all of a sudden, we have a less of a tax situation than what we ran into in 2019 automatically. Two, the markets are down, and when the markets are down, it does provide us an opportunity to move pre-tax dollars to an after-tax bucket via a Roth conversion that really provides a nice inheritance vehicle for the kids or grandkids at some time in the future. Again, a good conversation to be bringing your CPA into the conversation. As I mentioned before, you get the three of these parties talking together with each other. What a great opportunity to spend some time talking about where do we need to head from here. So some of the three big topics that we're seeing right now. We move back from the team conversation. Let's talk about the item I mentioned before, which is make a commitment and stay disciplined. It's more important than ever to make a commitment to ensure your financial well-being is in place. I'm going to give you a few examples. We all get tugged by that idea that maybe we should sit on the sidelines for a little bit and wait for the economy and the markets to get better. How do we need to do that? What should we do? The hard part with that is that we have to be dead right twice. We have to be right when to get in and when to get out. And that is difficult stuff to do. This slide that I have on the screen for you here gives a little representation of that. So this slide basically says, if we invested $10,000, again in the S&P 500, as you can see, this is S&P is my good representation of the US stock market. You'll hear me talk about it already a few times, and I'll talk about it some more. But if we invested $10,000 in the US stock market using the S&P 500, if we started this in December of 81 and we went through December of 2019, about 40 years, if we stayed fully invested during that time with $10,000, our balance grew to $535,000. A nice return that I think most of us would be happy with. Now, if we missed the best 5 days, just the best 5 days within that almost 40-year period, our investment would have grown, but only grown to $346,000. We lost out on $189,000 in gain. If we missed the best 10 days, you can see on the slide here that your growth changed from $535,000 to $258,000. We lost $277,000 in gains. And now if you go all the way over to the right, and it says, and the slide says, if you missed the best 50 days, so less than 2 months of that almost 40-year time frame, your investment grew from $10,000 to $47,000, and you missed out on $488,000 in gains. The point of this slide that you're probably seeing already, it is hard to predict when to get in, when to get out, because some of the best return days happen during volatile times. So again, the point of this slide is to stay the course. Make sure that we know where we're headed from here. The next slide, I won't spend too much time on. It drives home the point once again, but it focuses more on 2007 and 2009. From December of 07 to March of 09 was where we all know as the Great Recession. Okay? The numbers that we saw, the US stock market pulled back by over 50%, 50.6% to be exact. During that 2-year time frame approximately, we saw a dramatic feeling about where do we go from here? Is the market's going to recover? What are we ever going to do? But if you step back and take a look at the longer term perspective and the nice recovery, beyond nice recovery we've had since then, you can look at the chart on the right-hand side. Yes, from December of 07 through March of 09, we had a 50% pullback. But on the right-hand side, you can see from December of 07 to December of 2019, the markets have increased by 331%. Once again, looking at the S&P 500. Staying the course is a tried and true method, and it's one of the ones that we preach oftentimes to clients, even those that say, I don't know if I have time to write out the markets. One of the things we'll talk about here a little bit is how to structure your portfolio to be ready for those types of situations. One last slide I'll present, and then regarding the market volatility and how to navigate them and why to stay the course is this slide right here. And it's one of my favorites of the presentation today. The idea is it says on the top left, many of the best days occur during periods of volatility. So this slide, what we do is we look at the S&P 500 once again, and we say, what was the best 30 days since 1995? So over the last 25 years, what are the best 30 days that we've seen? And it's been, and you see the top 30 days listed here. We have them categorized a bit. The tech wreck, okay, so the early 2000s that most of us probably remember, the financial crisis that we all remember from 07 to 09, the COVID situation that's played out over the course of the last 6 months, 7 months, and then the other column. What you'll find here on this particular slide is during the COVID situation, 30 of the best days that we've seen since 1995, so 20% of those 30 days happened during the COVID situation this year, have happened this year during the COVID situation. What an extraordinary testament to, wow, let's look back during those timeframes. Look at the dates on these markets. You can see that most of these dates happened in March during the COVID situation. In March 24th of 2020, the market had a 9.4% gain. And March 13th of 2020, the market had a 9.3% gain. Think about back to March. It wasn't that long ago. Think about how everyone felt about the economy, the world, where we were headed from here. We really had a situation that nothing felt good at that time. No one felt the recovery was imminent. Now we get into a situation that, think about back in February. If you sold out at the end of February and you decided to get back in April, think about missing these best days. Again, my point is staying the course during market turbulence because you just don't know when those great days are going to come about. All right, so what do we do from here? What do we move? How do we do this? One of the things I talk to people a lot about when they come on board with us as clients is we need to set the right asset allocation. We need to have the right mix between stocks and bonds and cash. And within those parameters, we need to have the right stocks. We need to have large cap stocks, small cap stocks, mid cap, even a little international. And when we do that diversification and we don't try to guess when to get in, when to get out, we tilt the sail at the right times, it gives us the ability to have a good long-term rate of return with some consistency. So this little chart here goes back to 2009, and it runs all the way through 2019. And it says, here's the performance of the various indicators within the market. It gives you ideas about what the rate of returns have been in certain sectors: large cap stocks, small cap stocks, internationals, real estate indexes, commodities. And when you look at that, you're going to find if you track one of those investments in particular, it doesn't matter which one, but follow it through the chart, and you'll see you'll never see one consistently stay at the top across the board. You'll see some at the very top, some at the very bottom, and some that congregate in the middle. So one of the things that we work hard on here at the bank is to ensure that we're in a situation that we develop a balanced approach. And the example I'm giving you here is that if you were invested 60% stocks, 40% bonds in a portfolio, you see a much more consistent rate of return. You're never stuck at the bottom, you're never stuck at the top, but you see some consistency. And that type of situation is a good thing. It gives you some ability to stay the course and make sure that you're staying focused. So we'll spend a little time talking about asset allocation, but speaking with your advisor about what your asset allocation should be is a big deal. In fact, my quote that I have here on the next slide, asset allocation explains about 94% of the variation in a portfolio's quarterly rate of return. Again, not what stocks to buy, what bonds to buy. We need to start first with the right asset allocation. On this screen, we give you a quick little representation of what does a good asset allocation look like. We need to have parameters set. How much do we want in stocks as a maximum? How much do we want in stocks as a minimum? Same thing with bonds. What's our maximum? What's our minimum? Are we going to have any satellite classes like real estate indexes or cash? When we set those parameters, we stay that course, and we only move based off of life-changing events. Has there been a marriage, a death, a divorce? Has the income levels changed? That's when we get into a scenario where we want to talk more about asset allocations and which one's the right one for us. So again, speaking about how to set up your plan and staying disciplined, we want to make sure when you sit down with your advisor, you have a good strategy in place that you know at any given time how aggressive or conservative he or she's being. It's an important aspect to make sure that you have your plans in place based off of these asset allocations. So let's move on. Let's move away from staying disciplined and staying focused. And now we're going to move on to the idea of how do we make sure our savings are going to last our lifetimes? So the next question is, do you have a plan in place to ensure your savings will last as long as you do? And all too often we speak to the retiree that says, I've been putting into my 401k all my life. I don't know if it's going to last me. I haven't run any projections like reports to know where I'm at, where I'm going. And it does take some discipline to do that. It also takes some discipline to make sure that you're keeping an eye on those things when you get into retirement. For example, the last 6 to 7 months, we've seen major market volatility. Are we in a scenario that our portfolio can still sustain the withdrawals that we've been taking? Can we take some from our emergency fund for a little while to allow that portfolio to recover? So we get into a situation of making sure we're budgeting for our retirement income. And the next slide is nothing that my past professors would have been too pleased that I've given something so basic on the screen. But the idea being that when we get into a scenario of a yearly budget, how much are we spending every year? Write that down. Write down all the nuances of whether it be the hard bills like taxes and a mortgage payment perhaps, but also write in discretionary spending things as well. Then we need to understand what our current income is. What's our Social Security income? Do we have a pension coming in? We have rental income coming in from a home that we maybe have. When we get into that scenario of deciding what our expenses are minus our income, then we come into our income gap. What do we have in income that we need to make sure we're replacing? We get in that scenario and we need to decide, is it $1,000 a month that we need from our investment accounts? Is it $5,000? Is it $10,000? What do we need from our investment accounts to make sure that we're covering our income gap? Okay. One of the things that I always like to pull up is this quick little slide, and it talks about kind of the old theory of what's your number, because nobody's number is the same. I have clients across the board. I have the clients that walk in here that say, I don't need a dime for my investment accounts. I'm in retirement. I've got a good pension. I'm in great shape. I'm okay. I have the other clients that walk in here and say, I need a significant amount of income for my retirement savings because it's getting to be that time. I need additional income. So this is an interesting little slide. The slide basically says if you need $80,000 a year when you retire, your investment account that day you retire needs to be roughly $1 million. To be exact, $1,016,955. Now, when you have that balance, if you get a 5% rate of return in retirement, and you think about taxes and inflation, you would be able to be sustained withdrawals of $80,000 a year on your $1 million for approximately 20 years. At the end of 20 years, that balance would run to zero. And regardless of where you're investing, these are the hard and fast rules. $80,000 a year, you need $1 million in your account, and at the end of 20 years, you're out of money. If you told me you needed $60,000 a year, you're going to need that number that you can see there on the right, $762,000. If you need $40,000 a year, it's approximately $500,000, $508,000. If you need $20,000 a year, the number is now $254,000. Again, just a quick number to say, what should I be thinking about when I'm in retirement? What do I need to think about where I'm at from my number standpoint? The other item I talk to retirees about is let's make sure we're not hitting our investment accounts too hard and expecting too much from them. Here's a great example. When we get into retirement, one of the things I talk to clients a lot about is let's not tax into that retirement account too hard, too quickly. You get the question, should I pay off my mortgage? Should I do this? My comment is we have to be careful in those first handful of years, because if we don't, those first 5 years are going to dramatically influence years 10 and 15. And so this example here says, if we had $500,000 and we invested it with a 5% rate of return, and we took out a certain withdrawal rate each year. So you can see the red line here on the top says if we took out 4% of that account balance every year, that's approximately $20,000 or $1,600 a month. We have a sizable amount of our nest egg left at the end of 30 years. However, you can see those lines go down if we take out 5%, which is the yellow line. 6% is the green line, and all the way down to the bottom line, which is the 10% line, which means we're basically out of money in year 30. Again, getting the scenario of not being too dramatic on our investment withdrawals. We need to be disciplined about where we head with that. I give it as one more illustration regarding how do you make sure you've got a plan in place. One of the things that we do for our clients here a lot is put together financial plans that say, where do I stand? What happens with the amount of money I've saved today, and is it going to last over the course of time? It doesn't matter if we run those reports when you turn 65 and you just retired, or you're 75 and your income levels have changed and your needs have changed. Maybe we all of a sudden have a situation that we need to decide, boy, if I need $10,000 a month for assisted living costs, how do I get there? Is my investments going to withstand that? So we run financial planning projections like this. So here's a real basic one. This one says John Doe retires at age 65 and he has an investment of $500,000. He gets a rate of return of 6%, and he decides he's going to withdraw out of this investment account $30,000 a year, and he's in the 25% tax bracket. You can see John Doe on the right-hand side starts with his $500,000 in 2020. He's officially going to retire in 2021, and he withdraws $30,000 a year, getting a 6% rate of return along the way, still paying taxes on those distributions. At the end of 2042, at age 86, he's out of money. Now, the question is that okay with John Doe? Now, John Doe might say, absolutely, I'd be surprised if I live past age 80. Now, that's okay for someone to make sure that they understand that. But what if we said, wait a minute, what if I'm still here at age 86 and I need some additional dollars? We need to find a way to make sure we're understanding what withdrawals mean to your investment account. So maybe what we do then is we say, John Doe, let's run another projection. Let's do a 4% withdrawal rate over the course of time. So John Doe, age 65, still starting with that $500,000, still getting a 6% rate of return, still an average tax rate of 25%, but John changes his withdrawals from $30,000 a month to $20,000 a month. Now all of a sudden, we get this picture of a much, much different scenario. Now look down to age 90. In 2042, John still has $490,000 left inside of his investment account. We get a much more dramatic picture by changing that withdrawal method by about $10,000 a year. Instead of $30,000 a year, John's taking $20,000. The question is, John, does that sound like a better picture? And if so, let's start that strategy now at 65 rather than looking back at 75 and saying, oh no, I shouldn't have done that. One other point I'll make on this slide is that you see the numbers increase in 2034 at age 78. Our system's smart enough to know that John, if he's taking this money out of his IRA, his distributions need to increase each year to satisfy that RMD. So just a comment to make on that side note. I'll enter one other slide when it comes to financial planning projections. And this is more that I'd say you can give to the kids, the grandkids, if you're trying to teach them and coach them up on the importance of saving early. So this may not be applied to you. This is a nice little slide to, again, provide to the kids or the grandkids. Here's what it says. It says if you want to have $1 million accumulated by age 65, there's different ways of getting there. You start earlier, or do you be more aggressive with your savings later? So on the left-hand side, you can see at age 25, if John Doe started saving $381 a month, getting a 7% rate of return, John Doe at age 65 is going to have $1 million. Now, if John said, no, you know what, I've got college expenses, I got too many things going on that I want to buy, I'm going to wait till age 35. John now needs $820 a month with that 7% rate of return to get to $1 million. Same thing when we look at 45, if John is still delayed savings, now if he's going to start saving at 45 to put away his $1 million, he needs $1,900 a month, $1,920 to be exact, with a 7% rate of return to get the $1 million. And then when you get to the point of 55, the number becomes dramatically more. John now needs to save almost $5,800 a month with a 7% rate of return to reach $1 million. This is a nice little slide to show to the kids and the grandkids about why should they start pecking away in their 401k plans earlier rather than later. So again, maybe something you won't apply to your own financial situation, but a unique slide to give you a little perspective. So we've talked enough about what do we need to make sure we do to make sure that our investments are staying disciplined. We've talked a lot about what the financial plans we do. One of my favorite topics is, how do you measure success? What do you do at the end of the year, December 31st, when you're thinking about the new year, when you look back and reflect on the previous year, how did I do? And the question is, how did I do and how should I have done? Oftentimes when we bring a client on board as a new customer, one of the things that we ask them is, one of the first things we ask them is, how do you measure success and failures? And oftentimes the answer is, I'm not sure. I don't know. I sit down with my advisor once a year and we have a conversation and there's a little bit of this, that, or the other things. Here's what you need to do. These 3 bullet points. Item number 1, you need to set guidelines as to how you measure success and failures. And we'll give you an example here in a moment of how we do that here at the bank. The second item is you need to have the advisor provide you the tools to make those adjustments. How do I know that my returns are doing what they're supposed to do against the appropriate industry benchmarks? How do I know my advisor is doing what they're supposed to do? And how is peers doing out there? Is he or she doing the best job possible? And then we need to make sure that we're running these reports on a regular basis. So here's what I mean by that. When we get into a scenario, the first thing that we want to do when we start talking about performance, so if I talk about the client that walks in on December 31st and says, Cody, how did I do this year? One of the first things we want to do is set perspective. What was the year like? First of all, what we'll do is we'll talk about what did the markets do? You guys have heard me say a couple of times in this presentation, what's the benchmark rate of returns been for the S&P 500? Okay, so what's the S&P 500 done? Last year, as we mentioned, in 2019, the S&P had a really nice year. The markets were up almost 31.5%. Now, if you were invested fully in the S&P 500 during that time frame and nothing else, I should be looking back to you to say, Mr. and Mrs. Client, you received a rate of return at or near 31 to 31.5%. And if not, you need to say, why not? Now, the same conversation for investors in the S&P 500, if we were having the same conversation back in December of 2008, the S&P 500 produced a negative rate of return of almost 37%. To be exact, on the slide here, it's 36.99%. Then the question is, Cody, what did you do to help protect on the downside? Now, suddenly our investment conversation has more structure. We have the ability to understand what are we seeing from a return standpoint? Is it accomplishing what we need it to? So one of the things we do with our clients is we provide them a report. And the report looks something like this. And I know there's a lot of moving parts to this, but I'm going to direct you to the bottom of the page and it gets to be much cleaner and much easier to read. But this report, what it does, we provide this to our clients whenever they come in for their monthly or quarterly or annual meeting. We go over this report. And this report says, Mr. and Mrs. Client, on the left-hand side, here's how we had your portfolio invested between stocks and bonds and cash. Okay? And then what we do on the right-hand side, we talk about how those investments have performed over the course of the last 3 months, 6 months, 12 months, 3 years, 5 years, and they've been with us for 10 years. The report goes out longer. And what they're suddenly seeing is that they've got the ability to say, how's my portfolio done during those time frames? And then directly below it, how did the benchmarks do during that time? Again, mention the S&P 500. It's a nice little benchmark to use against large cap domestic stocks. Okay? It gives you some perspective as to how the investments have done. So if we go to the bottom of the page, this client knows over the last 3 months, this portfolio has produced about a 6.75% rate of return for them, and the benchmarks did 5.96. You can see the same numbers play out over the 6-month, fiscal year to date, the 12-month, the 3-year, and the 5-year. If you go to the right, at the bottom of the page, once again, it gives you what the portfolio returns were versus the benchmarks. Now, all of a sudden, you haven't had to pay attention to CNBC or the Wall Street Journal to get any kind of perspective about how the markets have done since your last meeting with your advisor. Suddenly, now you have some perspective to say, now I see they've done okay for me. They get to keep their job another year. Or, wow, I'm 2 or 3 or 4% off the benchmarks. I've got a problem. Why did my advisor miss? So this is a great situation that we want to make sure that people are getting into when they start talking to their advisors. The next item is that we want a cash flow report. When we get to the conversation of how am I doing in retirement, and I go to this report a lot of times in retirement, this report gives us a nice representation of where did I start? What was my balance at the beginning of the year or when I started with my firm? Maybe it was 10 years ago I started with this advisor. What was my balance when I started with you? Second thing is you want to talk about is what have I taken out? Have I taken money out to buy a home or a car or to help the grandkids with college? The third item is what have I put in? Have I put some money in some savings that I didn't have before that I put in after I opened the account? And then the very last number is what have I got for a balance today? Suddenly we get into a situation of we get a real nice representation of am I withdrawing too much from my retirement savings or am I on track? And if I'm withdrawing too much, is it because the rate of returns are trailing or am I being too aggressive with my spending from this account? So this is a nice representation that we sit down with our clients on a regular basis. It's a good thing for you to do with your advisors to make sure these types of discussions are taking place. Okay, so those two items when it comes to performance standards, I really want people to spend a good amount of time deciding how do we measure success? How do we measure the success of our advisor? How did we determine that he or she gets to keep their job another year as our advisor? Again, use industry benchmarks with a report that advisor should be providing you. And two, let's make sure we've got a good cash flow report so you know you're staying on track. The last question we're going to talk about is your financial advisor a fiduciary? And it's such a unique word, and oftentimes when I try to explain it within 30 seconds, it always takes a life of its own because there's so many moving parts to it. But by definition, a fiduciary is one who acts in the utmost good faith in a manner he or she reasonably believes to be in the best interest of their clients. So that individual that has to act in the best interest, legally bound to do so in the client's interest at any given time. Now, you would assume most financial advisors are fiduciaries. You would assume most financial advisors are required to follow these standards. However, there are different standards out there that require not every financial advisor to operate as a fiduciary. There's a standard out there called suitability. And that means that it's an after the advisor has taken a look at the individual's time horizon and risk tolerance and investment objectives, the things we've talked about before, they have to pick out an investment that would be suitable. Perhaps not the best investment for the individual, but one that is suitable. And that is a unique situation, and sometimes it's hard to explain. Oftentimes I use the following example to explain that. This is actually some verbiage that I had taken off of a statement that a client had provided me before they came on board with us that they received from their advisor. Before they came on board with us, they had this disclosure they received from their advisor, and they said, I didn't realize this. Why would I ever stay with an institution that has these types of standards? Let me read a couple of the excerpts. The potential for receipt of commissions provided me a financial incentive to recommend commodities or future products based on the compensation received rather than the client's needs. What a unique comment. Right there and then, the advisor has to tell the client, I'm going to put you in something that's suitable, but it may not be the best one for you. The next item that I'll read is the second bullet point. I may receive other compensation, such as mutual fund or money market 12B1 fees and variable annuity trails. The potential for receipt of commissions and other compensation gives me an incentive to recommend investment products based on the compensation received rather than on the client's needs. Wow, what a good comment to say, holy grief, why am I going to invest with an individual that could put me in a product that meets the suitability standards, but doesn't maybe meet the best product for me? So again, a couple of excerpts from some brokerage letters that we had received over the years, and one that particularly stood out to me is this particular one. So when we want to talk about cost, so if we want to talk about what cost means and what it means for your portfolio, I always tell folks, go back to your advisor and ask these questions. These questions give you a really nice perspective on what am I paying and what am I paying that I don't know about. Ask these questions to your advisor, put them in writing, hand them across the table to your advisor or email them to your advisor, and ask for these answers in writing. Ask for them in writing. Don't allow a phone call to say, you know what, let me walk you through them. Ask for them in writing. And this is a great way to determine, am I on the path that I need to with the right advisor? Again, going back to the question of, is my advisor a fiduciary? And as you can see here, I think there's definitely some different expectations with the fiduciary versus those that may not be a fiduciary in this industry. I want to summarize. We're getting close to the end of the presentation, but I want to summarize real quickly what we had talked about. Question one, how do I ensure my plans are in order? I talked to you a lot about developing a team and staying disciplined. A good team started with a financial advisor can really make sure that the world goes around for you in a much more efficient way, especially given the turbulent times that we're in today. Question two, do you have a plan in place to ensure savings will last as long as you do? It's really, really important to have financial projections ran on your investment accounts to know, is the withdrawals I'm taking today going to impact the withdrawals I need to take out 20 years from now? Question three, how do you and your financial advisor measure success and failure? Make sure that you have a good, consistent plan with your advisor. I gave you an example of how we do things here with our clients. Make sure you're measuring against the appropriate benchmarks. No, if it was a good year in the market, I should have made hay when the sun was shining. However, if it was a down year, what did you do to protect me? And I'm not saying that there's ever going to be a situation that you're not going to have to worry about losses in a portfolio. Of course, those will come with the markets, but over the course of time, you'll be able to recover those if we stay the course. But the idea is have that consistent plan in place with your financial advisor as to how you're going to measure success. The fourth question, and maybe the most important question, is your financial advisor a fiduciary? Make sure you're asking that question to your advisor and make sure you're understanding the fee structures that are involved. It's more important than ever to make sure now that we have the interest of our clients aligned with our interests. It makes a big, big difference in the performance of the portfolio over time to make sure that we have a good working relationship. That's the presentation of how not to outlast your money. We're really in a situation that we hope that this gives a little perspective and a little insight as to where we're at and what we're headed from here. If you have questions for us as an organization, you're more than welcome to give me a call or to send me an email. My contact information is here on the screen. It's again 563-388-2628, or my email address, which is callen, and I spell Allen, A-L-L-E-N, @northwestbank.com. I hope you're all well and safe and taking care in these most unique times. And till next time, thank you very much.